Alright, we're going to talk about bad debts, or otherwise known as uncollectible. Alright, we're going to talk about bad debt expense, otherwise known as uncollectible accounts expense. So what happens is a company makes a sale on account where they would debit accounts receivable and credit sales, and they expect to receive that money. Well, sometimes the customer doesn't pay the money, so the company needs to account for the fact that they are not going to get that money. There are two different methods to account for this. Both methods have to result in a credit to accounts receivable. So if you think about it, when a company originally makes the sale, they're going to have an account called accounts receivable, right? And then, so they're going to start off with accounts receivable, and we're going to usually have a customer name. And it would start off with a debit balance. Let's say they owed us $5,000. Well, when the company decides that they're not going to receive this, then they will need to get rid of the balance and take it off their books because they're not going to receive it. So no matter which method we're going to use, you're going to have to credit the accounts receivable to get it. Now the question is, when do you debit the bad debt expense? So we'll talk about that. The first method we're going to do is called the direct write-off method. This method is usually easier for students. It's more straightforward. However, it is not in compliance with GAAP. Okay, so recall that GAAP is generally accepted accounting principles, and that all companies that are publicly traded must be in compliance with GAAP. They must follow the GAAP rules. However, there are lots of companies that are not publicly traded that can choose other methods, and so those are the companies that may choose direct write-off method. Alright, so why is it not in compliance with GAAP? It is because direct write-off does not match the bad debt expense in the period that the sale was made. Instead, they wait until they actually write off the account, and then they do the bad debt at that time. So here's what it's going to look like. When a company decides that an account is uncollectible, they are going to simply debit uncollectible expense for $5,000. We'll just go ahead and use that example. And they're going to credit accounts receivable, the customer name, because they're no longer going to attempt to collect this, and they don't need to show it as an asset on their books anymore because they don't believe that they're going to receive it. Alright, if they did get the money later, like the customer went ahead and paid, then they would simply reverse this entry. So they would debit accounts receivable for $5,000 and credit uncollectible expense for $5,000, and then they would show that they received the money, so they would debit cash for $5,000 and they would credit accounts receivable for $5,000. So they would undo this account and then just receive the money as they normally would. Alright, so that's the direct write-off method. Okay, now to be in compliance with GAAP, you would use this method. It's called the allowance of uncollectibles, and it entails setting up an allowance account at the beginning of the period to estimate your bad debts. As I'll show you in a moment, there are two different ways to estimate it, but regardless of the way that you estimate it, the journal entry accounts will be the same. So the first one is going to be when you estimate it at the beginning of the period. You'll do your expense. It'll either be called bad debt expense or uncollectible account expense, and you'll credit allowance for uncollectibles. Let's talk about the allowance for uncollectible accounts. The allowance for uncollectible accounts is going to be a contra account. It's going to reduce your accounts receivable. So if you have an accounts receivable of, let's say you've got $15,000. I just need a little T account for y'all. Okay, so let's say people owe you $15,000 in total, and then let's say that you have estimated that 1% of that's not going to be collectible. So then you're going to have another account called allowance for uncollectibles. It's also a balance sheet account, and as you can see here, when we set it up, we credit it. So it's got a credit balance of, let's say it's got $1,500 in it. So if you want to know the net of how much you expect to receive from your customers, you would look at the $15,000 debit minus the $1,500 credit, and you would know that that would be the amount that you expect to receive, $15,000 minus $1,500. So, again, the allowance account is called a contra to the accounts receivable account, and that's why it has the opposite balance. All right, so this is when you estimate it at the beginning of the period. Then throughout the period, when you decide which customers are not going to pay you and you're ready to specifically write off an accounts receivable, this is what your journal entry is going to look like. It's going to be to reduce your allowance because you've used up some of it, and you're going to credit your accounts receivable for your customer name. So if you were doing the allowance method, these will be the accounts that you will use. Again, up here is where you set up your allowance at the beginning of the period, and here's where you write off a specific account using the allowance method. Okay, now we have two methods that we're going to learn about to estimate our allowance. The first one is going to be called percentage of sales. The second one is going to be called aging of accounts receivable. If you do the percent of sales method, you will look at your total sales, actually it'll be your credit sales, just the sales that were made on credit, times the percent that they estimated, and that's going to be your amount to estimate. And then the other method is the aging of accounts receivable, and I'll show you that one in a moment. Okay, so let's do the first one, percent of sales. Let's say we have $1 million of sales, and we're told that we're going to estimate 1/2% of total sales be considered uncollectible. So we'll say 1 million times 1% times 1/2. And when we multiply that out, we'll get $5,000. So we think that $5,000 will not be collectible. All right, so then we would come up here, and right here in this section where we are going to estimate at the beginning of the period, we would have a debit of $5,000 and a credit of $5,000. All right, and then when we decide a particular person's not going to pay, let's say they have an account for $1,000, we would debit allowance for uncollectibles and credit accounts receivable. Now notice in the second entry, when we figure out exactly who's not going to pay, it is just debiting and crediting balance sheet accounts. There's no more expense accounts being hit because we hit the whole expense account at the beginning of the period when we estimated this. And that's the whole point of this, that we're matching the expense in the same period that we earn the revenue so that we don't have a big unexpected expense later on. We're going to estimate it based on prior history of our company. Okay, so we can either do that method, which is going to be the percent of sales method, or the aging method. So let's look at an aging report. An aging report is a very useful report to people. So what they're going to have is they're going to see that they have in accounts receivable, so this is the accounts receivable account, $30,000 worth of current, meaning that these customers' bills are not yet due. Then, in this particular report, we have $25,000 in the customers whose accounts are 30 to 60 days old. So they've come due, but they're pretty recent. Then this company has $10,000 of customers that are 60 to 90 days past due. $5,000 are 90 to 120 days past due, and $2,000 are over 120. So what the company is going to do is they're going to look at past history and see how much of these different categories usually became uncollectible. So of the current, it's usually going to be a smaller percent. Let's just say it's 0.01. Of the 30 to 60, 90, let's say it's going to be 0.03. That's how much you will not be able to collect. Of 60 to 90, it's going to become more because these customers are already late, so it's more of a chance that they're not ever going to pay. And then 90 to 120, let's just say it's 15%. Over 120, that gets even harder to collect, so we'll say 40% of these never become collected. So we're going to multiply 30,000 times 1%, and we're going to decide that we're going to estimate that of the current, 300% will not be collectible. Then we're going to copy that formula all the way over. And then in order to figure out the total amount that we want to estimate, we'll just sum across here. Okay, the key difference in this is that this is the balance that we want to have in our allowance account. So over here, we just wanted to make an entry for $5,000. We did not care what was already in the allowance account. We just want to make the entry for $5,000. Over here, we want to get our balance to be $3,600. So if we already had, let's say, $1,000 over here, we want the balance to be $3,600. You ask yourself, how much would we need to get that to that balance? So we would need to make an entry right now of $4,600. Okay, and again, that's because we want to make the allowance account be the $3,600. So our journal entry would be for the $4,600 in this made-up example. $4,600, $4,600. And again, oops, wrong place. If we then found out somebody in particular didn't pay that owed us $1,000, we would just debit the allowance for $1,000, and we would credit accounts receivable for that customer's name of $1,000. Alright, so the main takeaway here is that the direct write-off method is where you just hit uncollectible expense in the customer's name at the time that you decide that it's written off. So there's no estimating going on. Alright, the problem with that is that it's not in compliance with GAAP. So only non-publicly traded companies and companies that do not have to be in compliance with GAAP would be able to use the direct write-off method. The next method is the allowance of uncollectibles. This is GAAP. Okay, and step number 1 of this is to estimate uncollectibles. In other words, set up the allowance account. And then, as a company deems an account uncollectible, we'll write off using the allowance account. Okay, so again, this step right here is where we estimate. This is where we actually do the write-off. Now, in order to do step 1, we have 2 choices. Under step 1, we will either use the percentage of sales method, in which case we will take total sales times a percent times another percent that they will give to you, and that will be your number for your estimate. Or you can do aging accounts receivable, in which case you will look at your aging report, get an estimate, add them together, and that's the balance that you want to have in your allowance account. So anything that you have, you will look at and make your balance be this number right here.